longer?
Our baseline, the ECB and other central banks will keep their policy rates at the current level or around the current level until late in 2024. This will ensure that inflation indeed goes down to target by 2025. So you have to have tight monetary policy in the foreseeable future to make sure that this actually takes place.
Well, again, going back to the report, one of the aspects that jumps out to me is that you mentioned that the immediate challenge for Europe is restoring price stability. Do rates have to stay where they are in order for that price stability target to be achieved?
Well, I think for most central banks in Europe, it's indeed true that monetary policy should remain tight for the time being. This will make sure that disinflation proceeds as we expect, but we have to put in the work. We have learned from history that if you that monetary policy tightening needs to be in place for a little while, that you have to be patient. And if you ease too early, this more often than not means that we have a resurgence of inflation that will mean that central banks will have to tighten even more at a higher cost later. So this is the right approach. Keep monetary policy tight for the time being to see disinflation through.
Well, inflation, as we know, tends to be driven at a headline level by food and energy prices. But you've got a full segment in the report dissecting what's happening with the labor market. Do you see persistent inflationary pressures emerging from the labor market?
I think the labor market is central both for our real economy forecast and for our forecast of inflation. To be clear, what we expect is wages to grow at a healthy pace, both in advanced economies and in emerging markets going forward. For advanced economies, for example, we assume 5% wage growth this year, 4% next, and still 3.5% in 2025. Now, this is a good thing. This supports real income growth. This supports consumption, which in turn will provide a bottom for GDP growth. However, it's also important that wage growth doesn't become exuberant, that it stays broadly in line with productivity growth. And so that's an area we have to watch. One aspect here is that policymakers can help with is productivity growth. So think about everything that helps Europe to increase medium-term growth, which we fear is still a little bit on the low side. And another aspect is monetary policy. Monetary policy, if it is tight enough, will make it more difficult for firms to pass on higher costs to prices, which will sort of also help anchor inflation.
And I also asked him about risks to Europe's medium-term growth outlook.
Q3 GDP numbers came in broadly as we expected, if you exclude Ireland, which is a very volatile GDP series. But it's true that Q4 could be a little bit weaker than we forecast. The high-frequency indicators seem to indicate as much. We are still not projecting a recession for Europe under the baseline, but clearly the recovery could be a little bit delayed. Another risk is that inflation could be higher than we currently expect. There are at least two reasons potentially for this. One is the conflict in the Middle East, that if it expands beyond the current localized state, could mean pressures for the global energy market. And we have learned the hard way that this means higher headline inflation for our European economies. Another aspect is wage growth. While wage growth is a part of our forecast, while we welcome real wages catching up, there is always the risk that wage growth becomes too far removed from productivity growth, and that could be another pressure point for the economy.
Let's get back to markets. We're just over an hour and a half into today's trading session, and overall the European market is trading marginally lower. We do have a little bit of green on the board. FTSE 100 holding on to 1 basis point of gains at the moment. You've got the Italian market underperforming, down about 0.7%. The Xetra DAX down about 0.4%, with a couple of big earners reporting today. Commerzbank trading very strongly, in fact, after they delivered a strong earnings update. We've also got M&S and Vestas trading very well this morning after results results as well. On the downside, Ahold Delhaize, the supermarket group, underperforming after the company trimmed its 2023 guidance and flagged margin weakness in the U.S. So a little bit of a flavor around what is performing best and worst this morning. Now, all of this comes after equities and fixed income rallied stateside yesterday. You had all three of the majors end in positive territory. The tech-heavy Nasdaq gaining 0.9%. Microsoft shares closing at a new record high, rising for 8 straight days for the first time since January 2021. A lot of excitement around AI for Microsoft. Dow Jones added about 56 points, and the S&P 500 gained about 0.3%. I want to take a step back, though, and show you how U.S. markets have been trading over the last week or so since the month of November kicked off. I mentioned Microsoft trading higher for 8 straight days. The tech-heavy Nasdaq as an overall index has also posted an 8-day win streak now. That's for the first time since 2021. S&P and the Dow have also been trading very well. 7 consecutive positive sessions for those two indices. Now, what is in store for today's session? Let's take a look at U.S. futures. Not a huge amount of action at this point. Very muted start indicated by those futures. Only double digits indicated for the Nasdaq, and even then, just 11 points lower indicated. We've got more Fed speakers to look out for today. Disney earnings and a 10-year Treasury auction will no doubt take some investor focus later on this afternoon.
What I think actually stands out to me in terms of the market action the last couple of weeks, Juliana, is how quickly the market has moved away from the higher for longer narrative to rate cuts in 2024. That is the major theme. We've spoken about it at the top of the show, but it is pretty significant that you're pricing in more than 100 basis points of cuts out of the Fed, the ECB, and actually the UK now after Hugh Pill's comments yesterday. And what that means is investors who had been quite comfortable being positioned in the higher for longer, higher rate scenario and also bearish equities positioning are now realizing that, well, the narrative has flipped on its head. Higher for longer is no longer the story. Now the story is about rate cuts, and which is why you're seeing such a vicious move in some of these yields, and also the surprising resilience in U.S. stock markets as well. That's been 7 or 8 days of consecutive gains in a row.
I think the strength of that narrative has surprised some, and I was reading a note earlier today from UBS that investors don't seem to really care that much about central bank speak at the moment. We've heard from a variety of Fed speakers yesterday, and we had a range of voices. Not a huge amount to change the market narrative. It feels as though investors are so comfortable, so confident in this new narrative that rates have peaked, that even if we hear different signaling from central bankers, it doesn't seem like it's going to move the needle much. Investors really believe in this narrative now that rates have peaked.
Yeah, even if they're trying to push back, but which is why the market reaction to Hugh Pill yesterday was interesting, because he didn't push back against what was already priced in. There was about 70 basis point priced in, and the market took that as even more reason to price in further interest rate cuts. One other thing that I do want to mention as well, what I think is relevant, is the price of oil and what's happening there. Again, that was a major theme. We talk about this inflationary theme. Another leg up in oil could be one reason for central banks perhaps to maintain a hawkish bias. But oil prices have started to drop in the last couple of days. And originally, the catalyst, as we know, was the market being in a state of deficit and geopolitical concerns. Now, once more, the narrative has changed towards growth next year and weaker demand coming out of China, the buildup of supply coming out of other parts of the world, the US included. And so on the back of that, there's been a lot of downward pressure on energy markets as well. You could also point that down to positioning, but I think it's quite telling what's happening in those markets too.
It does seem as though positioning has changed in oil markets, with a lot of the traders who took out long positions after Hamas's attack on Israel closing those positions now on the view that the conflict at the moment is likely not to escalate from here. But on that note, let's talk about the latest. Fighting has intensified in the Gaza Strip on Tuesday as Israeli forces encircled Gaza City, and Hamas said it had inflicted heavy losses. In a televised statement, Israeli Prime Minister Benjamin Netanyahu said there would be no ceasefire before hostages were released, and urged people in Gaza to move south, warning that Israel will not stop. NBC's Hala Garani filed this report from Tel Aviv.
The Gaza war is entering its second month, and the Israeli Prime Minister Benjamin Netanyahu has announced that his military is now encircling Gaza City and has cut off the northern tip of the territory from the southern parts of the Gaza Strip. He has said in interviews that Israel may consider some, quote, short tactical pauses to allow aid in, but also said that there is no talk of any ceasefire on the table unless all hostages are released. He also said something that has raised the interest of many people listening to the Israeli Prime Minister, that the security of the Gaza Strip may be handled by Israel for, quote, an indefinite period of time. What does that mean? Does that mean a buffer zone? Does it mean some sort of security cordon? Or does it mean something deeper, like a reoccupation of the Gaza Strip? We know the United States has said that it is very much opposed to that idea. Now, there are some reports that humanitarian convoys have been hit on their way to the southern part of the Strip. The Palestinian Red Crescent and the ICRC have said that a humanitarian convoy was targeted, and meantime hospitals and medical facilities are complaining once again that the lack of fuel is forcing them to ration care to those people who need it most. One very small bright spot, the number of evacuees through the Rafah border crossing into Egypt has increased. Up to 500 people have crossed. Most are dual nationals and foreign nationals, and a handful as well of injured Gazans have made it out. Back to you.
That was NBC's Hala Garani reporting from Tel Aviv. Coming up on the show, ARM is set to report earnings after the bell today, the first since the company's blockbuster IPO. We'll discuss what to expect next.
Welcome back to the show. Well, lots of commentary coming out of central banks today. I just want to bring you some lines from the Bank of England Governor Andrew Bailey. He is speaking at a panel at the Central Bank of Ireland up in Dublin. But let me just bring you some interesting lines around monetary policy and inflation. So he is saying he expects the next inflation read to be quite a bit lower by year end. Also, it should be not down to 2%, but still quite a bit lower by the end of the year. We think policy is now restrictive, economic growth very subdued. Basic message is that we believe policy will need to be restrictive for extended period, but there is still upside risk, mirroring the language, of course, that we got out of that Bank of England monetary policy statement last week. Really too early to be talking about cutting rates. Again, he mentioned that in the press conference last week. But I think it is interesting to note that they do expect these inflation rates to start dropping quite rapidly in the next couple of months.
Let's turn our attention back to earnings now. Disney is set to post fourth quarter results after the market closed today, with Wall Street expecting EPS to more than double on the year, with revenue seen rising double digits. CNBC's Julia Borstein will be speaking with the CEO Bob Iger in an exclusive interview today. You can catch that at 22:05 CET.
And ARM is set to release its first set of earnings since going public in September. The semiconductor firm is expected to post more than $740 million in revenue in its second quarter, according to LSEG estimates. Really happy to say that Neil Shah, partner and co-founder of Counterpoint Research, joins us. Neil, I guess the obvious question is, has the ARM listing or the fact that it is now a public company influenced at all, or will it have any bearings on the set of results that we're going to get today?
I think yes. So the timing is right for ARM to go public, and they have been planning this for years, and it's great for SoftBank as well. So with respect to earnings, I think they have pivoted to a newer business model, newer licensing model, which will help them increase their earnings almost every quarter from now on. So on an average, they used to get almost 2%, 1.7 to 2% royalties of a $200 billion semiconductor market. But now with the new licensing model, I think they should try to maximize it.
I want to ask you about where the growth opportunities reside. I remember in the build-up to the IPO, we had lots of conversations about ARM and the fact that their technology, their IP is so present in many smartphones. I believe they've got more than a market share of more than 90 or 95% when it comes to these smartphones. So in terms of growth, where do they go from there? They've tapped out the smartphone market already.
Absolutely. So smartphone has been their number one market because of their low power computational capability. So 99% of the smartphones are powered by ARM IP. The next big growth for them is with all the onset of AI we are seeing everywhere, right? So data center, HPC, which is called high performance computer, right? So that is going to be the biggest revenue generator and opportunity for ARM, followed by automotive, PCs. If you look at in PCs as well, the MacBooks, the new MacBooks have done really well. They are all ARM-based IP, and now it's taking on Intel with new Qualcomm-based chipsets, right? So PCs, automotive, servers, cloud computing, and IoT. These are the four big opportunities for ARM, where it is underpenetrated compared to smartphones.
Neil, what is the biggest risk for ARM when it comes to these efforts to unlock value and really maximize their potential to monetize the technology that they have?
It's the new business model itself is a little bit risky because they're going away from traditional per chip licensing to almost completely portfolio licensing, which increases the IP licensing cost and some cost to the end OEMs as well as the customers. So, but again, ARM has a great IP. So eventually, I think customers will get warmed up to the new business model, a licensing model. Apart from that, the biggest risk, I would say, overexposure to China. If you look at most of the technology giants in the smartphone space or PC space, or also with respect to other IoT, right? It's mostly Chinese brands. And if you look at ARM, China is an independent subsidiary directly of SoftBank. So ARM do not have complete control over ARM China. So there is a lot of geopolitical risk associated with ARM China as well.
What are you expecting to hear on that front today? I know this was one of the biggest deterrents for some investors in getting involved in the IPO was this lack of governance, lack of control over the China exposure. What might we hear from ARM today in terms of what's happening in China?
I think so far their IP licensing agreement looks solid, but still this is going to remain a hanging sword for ARM. But I think they still have very unique IP. It's very difficult to replicate it overnight, and their customers, end customers in China, to move away from ARM IP. Obviously, there are competing technologies like RISC-V, and then there is Imagination technologies as well. Some are building their own proprietary IP. But the major deviation is where ARM executives can appease investors on how much control they have over all the new opportunities they're seeing in the market.
Well, this is obviously the first set of earnings that we're going to get from from ARM since the blockbuster IPO. How should we think about read across to other companies in this space?
ARM is in a unique position. So if they're seeing some growth in terms of revenue compared to the last quarter, which is a positive sign, because until for last 2 years almost since the Ukraine-Russia war, we have seen the demand for smartphones have been going down. There is a lot of inventory in the market. There was until June, and we saw ARM's earnings also dipped in Q2, which is a June ending quarter. But if there is a slight uptake, which means the market is opening up a little bit, and we could see some favorable growth in the biggest consumer electronics market, with smartphones. So that could be a good representation.
Yeah, fascinating. Well, let's look out and see what's in store for us later today with the results. Neil Shah, partner and co-founder of Counterpoint Research. Let's take a look back at how European markets are faring, because we are now seeing a day of red across the board. We started off slightly mixed. The Stock 600 was trading around the flat line, but since then we have turned a lot more negative. A lot of focus today on earnings, some of the results that have coming through. Earlier on the show, we were talking about the likes of Adidas, Bayer as well, one to watch in Germany too. And of course, within the Dutch index, not shown here, but we are seeing a deep down day for the likes of Ahold Delhaize. But in terms of positive stocks, the Marks and Spencer is right at the top of the FTSE 100, up more than 8%. And then we also, earlier on in the show, were talking about Vestas, and the company there, surprisingly, actually is up 8% despite the very difficult journey these wind companies have been on the last couple of months.
I think encouraging commentary from the CEO that he thinks, anyway, they're at an inflection point. And our guest, Jacob Peterson, agreed that Vestas may, in fact, have crossed an inflection point and things could be getting easier. It seems like those supply chain issues are beginning to ease and the supply chains are normalizing. Let's get a check on U.S. futures. What's in store for the Wall Street Open? Really not a huge amount of action. We are flatlining right now across all three of the majors after 8 straight days of gains, though, for the tech-heavy NASDAQ. For the S&P and the Dow, we were looking at 7 consecutive positive sessions. This is the first time since late 2021 we've had winning streaks like this. And to your point, it seems all about the Fed narrative.
Well, and to that point, let's watch out for what Powell has to say Wednesday and Thursday this week. So with that, we will hand you over to Worldwide Exchange. That is it for our show. I'm Jemana Versace.
And I'm Juliana Tattlebaum. We'll see you tomorrow. Yes, I am. Okay. Yeah. I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Crude prices have fallen to a 3-month low amid concerns over dampened demand in the face of a weak global data overshadowing risks. A weak global data? Hey there. Great. Yes. Thank you. Frank, good morning to you. Well, here in Europe, we're off to a pretty lackluster start as well, a little bit more so even than what those U.S. futures indicate is in store for stateside trade. You've got red for the most part. At one stage this morning, every major region was trading lower. Now we've got the Spanish market dipping its toes into positive territory. The Xetra DAX is down about 0.4% in Germany. Some big corporates reporting their earnings today in Germany. You had Adidas. They already pre-released a strong set of results in mid-October, so today confirming those numbers. Bayer, that stock under a little bit of pressure after delivering results today. Commerzbank, in contrast, performing quite well after delivering their latest earnings. FTSE 100 down about 10 basis points or so. The Swiss market hovering around the flat line, and you do have some underperformance in Italy with the FTSE MIB down about 0.6%. Now, European retailers are split down the aisle on a busy earnings day. You've got Marks & Spencer's soaring as it restores its dividend for the first time in 4 years. But Ahold Delhaize, the supermarket group, is under pressure after cutting its profit outlook. In particular, Ahold Delhaize flagged margin weakness in the United States. And you can see a very dramatic difference in share price reaction. Marks & Spencer's up nearly 10% and Ahold Delhaize down nearly 8%. The Marks & Spencer share price has had an extraordinary run, up more than 100% year to date, and today's earnings no doubt giving some more fuel to the fire for investors as they now deliver on the dividend for the first time in 4 years. Frank? Thank you. I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Crude prices have fallen to a 3-month low as weaker global data dampens demand for the commodity, overshadowing risks that the Israel-Hamas conflict could spill over to the Middle East. That story is on the website now. Super Mario is set to get some company on the silver screen after Nintendo announced plans to make a live-action film based on its Legend of Zelda series. The move comes after the Super Mario Bros. Movie grossed more than $1 billion after its release in April. Head online for the full story. And China's economic recovery has been a bumpy one, but one sector in particular is seeing stellar growth: electric vehicles. That's according to Standard Chartered CEO Bill Winters, who told CNBC that China is, quote, absolutely booming when it comes to EV adoption. Check out that and all the top trending stories on CNBC.com.